Well, excellent. We're excited to give this webinar. We've given several webinars to the LawBank community, and we've been chosen as a vendor partner in the financial planning and wealth management space to work with the members of LawBank and work with a particular member of LawBank for a number of years. And with that, I will keep it super short and turn it over to Brennan Hannon, who is with College Invest, a great partner of ours.
Brennan, I think you're on mute.
Sorry about that. Hello, everybody. I hope everybody's doing well. I'm going to start sharing my screen right away, so you're probably going to lose the large video of me, which is good because we have, like I said, a lot of snow up here, and it's very bright behind me for some reason today. So I come from College Invest. We are a little bit of both debt reduction and also saving, so that the next generation of folks in your family don't have to experience maybe the same amount of student debts that you experienced. So who is College Invest? We're the 529 plan in the state of Colorado. So we're part of the Department of Higher Education. We're a not-for-profit. We partner really closely with Maya Wealth on all kinds of things. And this is one of those opportunities where we're working together, in this case, to really help lawyers both reduce their student debt, understand what current programs are available to you guys, and then also talk about how you're going to change things going forward in the future. So like I said, we do the 529 plan. We're not funded by taxpayer money. We're now the 10th largest plan in the country. The important part about that is that means we get great business partners to work with, such as Maya Wealth. And we're one of the most diverse programs in the country as far as what we offer for options. So that's really important for Colorado citizens for sure. We know there's 3 ways to pay for college. You can pay for it, ahead of time. You can save. You can pay for it during, which isn't feasible for most of us. Number 3, most of us pay for this afterwards, right? We borrowed money, especially for law school, because it does tend to cost so much more than some of the other education options. So what that really means is we can maybe, going forward, be in a better position by using a 529. So before I get into how you might do that, I just kind of want to go over some of the key benefits. What is a 529? Why is it good? So one of them, of course, is flexibility. This means you can change the ownership, you can change the beneficiary, you can transfer money from generation to generation. So it's a good wealth transfer tool as well as a college savings tool. Another one of the important features is that there's the tax advantages that come with the 529. It grows free of federal taxes, and then the withdrawals are free of federal taxes and state as well. So there's tax advantages. You can use it anywhere across the globe. This is a common misconception. People think you have to use it here in the States or maybe even here in Colorado, but you can use it across the world. And the money is available right away. There's no minimum holding period. So when you put money in here, you can pass it through, as a matter of fact. And we're going to talk about how that's important for debt reduction in a minute. Also, of course, you can put up to $400,000 in one of these accounts, more than enough for most people to save for college. But nonetheless, really good, again, for families using it as wealth transfer or even for some debt reduction. So what does the tax advantage look like? In Colorado, we're really lucky. There's a tax deduction dollar for dollar against your AGI, and there's no limit on that. And there's also no income limit. So it doesn't matter how much you make, you're still eligible for the tax deduction. So it's unique in Colorado because we don't have some of those limitations that are more common. The growth in there is tax-free. So if you've had a 529 for a while and you've realized from tax-free growth, you'll be able to use that to pay down some student debt. And then there's tax-free distributions, and that's for what's considered qualified higher educational expenses. The federal government has a list of those, and so does each state, and they differ from state to state. So I'm going to talk about the special aspects in Colorado. I want to kind of touch on student loans real quick because I think it helps to understand what they look like. So you can see some of these limits. I'm not going to go over these for anybody. The point is they're not very high. The aggregate limits are pretty low, especially when you're talking about paying for law school, which means a lot of us might have even some private student loans, or a lot of our student debt might be unsubsidized. And what that means is we've been paying interest on those loans since we first took them out, even during school, because you can only get so much in subsidized money regardless of your income level. So we know that we've had, what we're trying to do is avoid paying more and more interest. One of the ways we can do that, technically you can use a 529 plan to pay down student debt. So if you had a 529 plan, or if you've had one, you can do that. It's free of federal tax, there's no penalty. There's not a state tax benefit for it though, and this is kind of a period of confusion for people right now, because the federal government said, yes, you can use them for student loans. The state of Colorado had some bills in the legislature to get that approved, and then COVID came and the legislature had an emergency adjournment, and we don't know what will happen or when it will happen as far as if they'll start to include student loan payments as what's considered a qualified withdrawal. So you could still use the money, it just wouldn't be eligible for the state tax deduction. But you can still have friends and family help, and you can use your own spending to help as well, business and personal spending. So this is something I definitely like to bring up with business owners or families who are saving for college. This You Promise on the left, you can go to that website, you can register any credit card you regularly use, and it will, at places you spend money, it will add up rewards. Those rewards are then deposited to your 529, and then you could use it to pay off student debt or to save for your next generation of college. You Gift on the right here, this one's especially nice. This one lets anybody you know deposit to your 529 without having to give them an account number or any kind of data security issues. So they can, if you own a 529, you can go in and send an email and invite family members to help. Really common for people saving for college, and also becoming more common for people who might be using them to pay down some student debt, as we see grandparents and aunts and uncles start to help with that process as well. So that's just one way you can kind of pool money. In Colorado, this is less about debt payoff and more about saving for the future. But for new children, College Invest will now put the first $100 in any account that's open, as long as you do it before the kid turns 5. So for those of you with growing families or planning a family right now, this is going to be something you really want to keep in mind, to at least get the free $100 in there and get that growing for you. Another thing I want to talk about, because we might have a lot of self-employed folks that have S-corps or LLCs that are paying themselves a salary. You can, as an employer, put money into your 529, and you would get a 20% state tax credit on the business side, and it does pass through, right, if you're an S-corp and you're filing taxes that way. So that 20% tax credit for employers is good for up to $500 per employee per year. We have, I would say 150 companies, I think, that are doing this right now. And I know at least a third of them are S-corps, law firms, CPAs, advisory firms that have learned about it earliest and are taking advantage of that option. So that's one more thing to keep in mind as you're thinking about doing that. And like I said, any size company can participate, so it doesn't matter, even if you're self-employed, that would still work for you. Just to kind of be a little timely, I wanted to touch on what does COVID and college savings or debt reduction look like. And this applies to investing in general, but right now we have a really unique opportunity, right? Because you can automate your savings, put money into an investment account, and you can get dollar cost averaging, which for many years hasn't really been as helpful because the market continued to go up and up and up. But right now, when we see this volatility, it gives us a chance to buy at the dips, which we haven't had in a while. So this is a huge opportunity for investors that automate their investing. Age-based portfolios, some people might see this as target date funds in retirement accounts, but those are available in 529s, and they auto adjust. So if you have a 17-year-old today and you've been using age-based portfolios, you'll notice their portfolio hasn't really been affected by these market fluctuations because it's in investments that are made to be a little more stable as they get ready to go off to college. And the other thing is we might see an increase in disposable income, and Mark and Dave are going to talk about this probably, but this is a really important time when we're saving money commuting, or maybe we're not paying for parking or buying lunch, when we're going to work. This is a huge opportunity for us to both pay off debt and set aside savings. So just something to keep in mind when we're thinking about how we might be spending some of that extra money coming in. Another really important piece for self-employed people that is happening only this year is that if, as an employer, you make payments to your employees' student loans, which in most cases would be yourself, It's not taxable income, and that's really unique. It's never been like that before. The CARES Act for the year 2020 has said they're going to make this a temporary option for employers, so they can help employees, or self-employed people can help themselves a little bit. As part of attending this presentation, if you do open a 529, we'll put the first $25 in. So reach out to Mark or Dave on how to make that happen. But we'll make sure we get that to happen for you. And I know we're going to get to Dave really quick here, so I'm going to just see if there's any questions before we move over. Okay. There's my information. If you want to reach out to me directly, Mark or Dave are probably your first best points of contact. But if you have any questions, feel free to email or call me as well. Thank you so much.
Brennan, thank you so much. He has been an excellent partner of ours in the college planning space, particularly with 529s for quite a while, and we are fortunate to be partnered with him. I'm trying to talk and share my screen at the same time. Apparently, I can't multitask. This is my family right here. You see a picture, and yes, there are roughly 1 million of us. So, both college savings and debt reduction strategies are, both of those things are highly, highly valuable to me. I'd like to start, actually, before I dive into this, I'd like to start by describing a new partnership that Mark and I at Maya Wealth have with a local credit union here in town. And what this credit union offers is some really innovative ways to assist young professionals, probably like yourselves, who have possibly, this mountain of debt, particularly in student loans. How to structure that debt in such a way that it minimizes your payments and reduces overall interest. Now, this is not simply a debt consolidation program. It's actually, like I said, very innovative. It's the first time I've ever seen anything like this. I think they created the system themselves. That relationship for us is very new. And so we were hoping to have one of the representatives from the credit union on this webinar today. Unfortunately, nobody was available with the short notice that they had to prepare. But the point is, certainly reach out to Mark or myself. We can make those connections, help you make those connections where it makes sense. And then kind of what I wanted to dive into, and I'll spend just a couple of minutes on this, and then we'll open it up for questions and hopefully give you some of your day back. I want to talk about how it is, when we're able to find and recapture some excess funds, maybe through the credit union program or maybe through savings and driving and parking and things like that Brennan had mentioned. One of the questions is, okay, now what do we do with that money? And the knee-jerk reaction is, I'm going to take those funds and apply them to my debts, maybe my student loans. Sometimes that is the right way to go, and sometimes it's not. So this is where I would suggest looking at finances using a comprehensive approach is likely going to yield better results over time than looking at things siloed. And by siloed, I mean I've got my debt over here, I've got my income over here, I've got retirement plans over here, and none of these things really talk to each other. So what I have here is a sample. Susan is 30 years old. So she's an associate at a law firm. She's single, has a 2-year-old son, and about $100,000 in student debt. We plugged in $30,000 for her undergrad and $70,000 for law school debt. And so what we've done is we ran some modeling on what a debt reconstruction program might look like through the credit union. We were able to take those extra funds from Susan's budget, and we're gonna look at how we'll apply those funds. And so what I did is I said, first we're gonna take that extra money and pay off the undergrad debt because it's the smaller one in this case, and interest rates are roughly the same. I said we're gonna pay off that undergrad first, and then we're gonna take the entire balance of those payments, apply them all to the law school debt. And then once that's paid off, we're going to take that entire balance and turn it into contributions. And we said, okay, what does that do for Susan's retirement scenario? And you see a graph here that kind of shows her accumulation years, retirement, and then distribution. And what we see is that, you know, in her case, this gains $7.5 million. Now, before you roll your eyes, just remember that this is a sample to look at math. Obviously, there are a lot of pieces of Susan's puzzle that we don't have built in here. What we're really doing here is just looking at mathematically what makes more sense. So $7.5 million is not a terrible gain. What if instead we take those extra funds that we've been able to recapture, we begin investing them now, and then as the student loans are paid off, then we'll take those payment amounts and apply those to the investments as well. And we find that in this particular case, the total portfolio value grows even more than paying off the debt. Now, please understand, I'm not saying that you should always take those extra funds and invest them instead of paying off debt. Just as I would say that we don't want to make it a knee-jerk reaction to pay off the debt first, I would also say we don't want to make a knee-jerk reaction to invest first. Everybody's situation is different. There are a lot of variables that go into this. But I would suggest that this is something that we want to evaluate on a case-by-case basis. Now, as we talk about investing, a lot of people do not understand all of the fees that can be involved with investment accounts. Many of those fees, unfortunately, are hidden. Being at Maya Wealth, we're an independent firm, which means we don't have any obligations to use any particular set of funds. We're completely independent. We're not married to anybody. And we have the entire investing world in front of us. And very often we find that what we can do for our clients is, if nothing else, help them reduce fees. And so I've got Susan's scenario here based on her current retirement savings. And I said, well, if we can help her reduce her fees just by 0.5% in her IRA, and maybe make some suggestions to her in the 401k and reduce those just by 0.3% per year, what kind of a dramatic impact that has on her life as a whole. And like I said, we've done nothing but more than reduce fees here. It's important to note when you look at kind of the planning piece, the comprehensive planning piece, that this chart right here uses a straight line average, meaning if we are saying that a particular investment account is going to earn 6, then this says we're going to earn 6% every single year. I think you and I both know that's not the way that it works. And so as part of a comprehensive plan, one of the things we're going to evaluate is probability. And how likely is a plan to work out, understanding that there can be a lot of volatility in the market. And so as we work with our clients, this really is the primary number that we're tracking. What is our probability of success? I'd like to go back to Susan just for a moment. And this is going to conclude with the debt conversation that we have as well. So we have Susan's scenario here. It's important to remember that while we're focused on paying off debt and saving for retirement, we really have two massive risks that tend to apply to everybody globally. The first is the risk of being unable to work. Now, when we talk about disability, a lot of people think what we're talking about is something catastrophic where you become a quadriplegic and you live the rest of your life in a wheelchair. Although that happens, really what disability usually means is, getting cancer, having maybe a back injury, something like that. And you're going to be unable to work for a couple of years, but you're also going to be able to recover and go back. According to the Social Security Administration, the chances of someone between 25 and 65 becoming disabled for a period of more than 90 days is about 1 in 4. And so this is a more common risk than a lot of people realize. So I plugged in here at 37. Susan has a successful battle with cancer, but for 2 years she was unable to work. She got the employer disability plan, which is 60% of her base income. But without making any lifestyle changes or anything like that, we have a catastrophic impact on her plan overall. Of course, the risk of dying early, of premature death, exists as well. And we see that for her 2-year-old son, certainly that has some catastrophic impact as well. What I wanted to wrap up with is simply what a comprehensive approach might look like. And as I said, we talk about debt reduction strategies as well, and we'll evaluate them alongside other things. One of those pieces is, what if we add a supplemental disability policy to Linda's group policy? Well, now the disability is still going to be challenging, but it certainly doesn't have the impact that it would have had otherwise. Again, going back to that monthly sum that we were able to recapture and working through the debt reconstruction program through the credit union. If we recapture that and instead of just throwing it in the market, reinvest that very strategically. And I won't go into details today on exactly what this strategic investment looks like, but you know, as a one-off, we certainly would be happy to go into detail with you if that's appropriate. I'll also plug in recapturing house payments once the house is paid off. And now, in this scenario, we're looking at increasing portfolio value overall. If Susan passes away early, then of course we've still got a lot of years of lost income, but we have taken account for a premature death. We have taken that into account. Now, if Susan goes ahead and survives to retirement, then that's really where the magic that we created up here can be applied, and we can really drive portfolio values higher, as well as probabilities of success. There are some additional risks, and really there are a lot more pieces that we need to be able to look at with anybody's given scenario. But the point is, we're often able to accomplish results that are much better using the same amount of money. And so in this scenario, we didn't take any more money. We're not spending or contributing any more money than Susan was additionally. We simply reallocated what she's already using. So that is what I wanted to share with you today. I'll leave you some contact information for Mark and myself. Certainly suggest scheduling a 15-minute phone call. You can go to this website to do so. As I said, with the credit union, we can help you get connected with the right people there. Help you set up your 529s if that's the space that you're in right now. And certainly assist you with risk mitigation as well as retirement planning. That's what I have. If anybody has any questions, certainly feel free to jump in, or you can email Mark or myself, and certainly we'll send a follow-up email to each of you who are on the video today as well.
Any questions we can answer at this time?
So this is Miranda. Mark and Dave, I just wanted to say, and Brennan, I just want to say thank you for this. I think what kind of wasn't gone over at the beginning of the presentation is how Maya Wealth specializes in working with attorneys and law firms when it comes to wealth management, but especially when it comes for young attorneys, when it comes to these debt reduction strategies. I've seen these work. You know, personal planning really is the way to help yourself elevate during the course of your career. So the things that Dave and Mark and Brennan are chatting about today absolutely work and are applicable to Colorado lawyers. So not to get too chatty about this, but I do appreciate this from both of you, and I have taken down all of the attendees today if anybody would like any follow-up information.
Thank you very much for your time.
Awesome.
I do have a quick question if I could.
Yeah, go ahead.
So, hi, my name is Samantha. I work with Miranda at Denver Legal Marketing, and I purchased a very expensive law degree, right? Everyone knows they're not cheap. It was well worth the money. I can tell you that without even quoting you a price on what it cost, but it's definitely been, you know, a wonderful, it's opened many, many doors for me. and I do maintain income from like both self-employment, regular employment, and passive sources. What really made my ears perk up was how, thanks to the CARES Act, there is some tax breaks for being an employer who pays student loans. And since I'm my own employer in a variety of functions, like, you know, I can kind of make some moves to save myself some money on both taxes and student loans, I'm sure. But this is all predicating a question that is supposed to be quite simple, and that is, what, if any, are the business structure limitations? Do you have to be a W-4, W-2 employee? Can you be a 1099 contractor? Does this also apply to passive income, such as like rental income or anything like that? Like, what are the qualifications on that, sort of like on that, that benefit?
So this I would actually have to check with a CPA to make sure that I understood, you know, the kind of the employer structures that work. But if you're familiar with the tuition reimbursement plan, what they did was they basically rolled in the student debt payoff and mirrored it like the tuition reimbursement plan. So there's a lot more to read about when you look at the tuition reimbursement plan. So as you're doing research, that might be a good way to search, because it basically falls under the same rules. So that means it is limited to $5,252 a year, just like the tuition reimbursement limit. And any employer who's paying employees should be eligible. We're not aware of any requirements that it be a C Corp or, you know, or an S Corp or anything like that. Usually what's required is that you're paying the employee a salary. So for some self-employed, that might exclude you. You know, let's say you're a partnership, for example, and you're only taking distributions. That might affect you. But otherwise, for most employers, it still works.
Great, thank you. I appreciate that. Definitely something to look into. Absolutely. Thanks again.
Yeah, I'll do some research too and send it on to Dave and Mark so they can forward it on to you.
Yeah, and I just wanted to chime in, Samantha. Certainly would love to schedule a brief conversation and make sure that we answer that in its entirety, given your specific situation.
Yes, thank you. I kind of fall into that like sort of gap of people who feel like I don't really, like, my financial situation has some moving parts to it, but I just don't feel like I generate enough wealth to work with a wealth manager, you know? And so maybe that's just like a hurdle I have to get over on my own, right?
We work with people we like, and we don't have a minimum investable asset limit. We love to help out.
Wonderful. Glad to hear it.
Yeah. Any other questions?
Everyone's so quiet.
Yeah.
Maybe everyone's having a little lunch.
Yeah, that's true.
I did have one question. Hi, everyone. I'm Jessie Bauer. With regards to the tools that you were showing us about debt reduction and sort of portfolio development, do you have the capability within that software, and maybe this is something that everyone else knows and I don't, but if I own a rental house and a house that I live in, and I have like a debt reduction strategy that I'm working towards, could you plug all of these assets in and actually make recommendations to me about whether or not it was smarter to sell the real estate in order to pay off, you know, the loans at a faster rate for, you know, an overall wealth strategy, just to sort of think about what the actual overall ROI for myself is on a long-term plan?
Absolutely. That's a great question. This software is incredibly robust, and so there's really nothing in the financial world that we can't do. And so, you know, to give you an example, one of the things that we can do is plug in various real estate holdings that you have, rentals, what have you, and you know, even create a schedule which includes depreciation, the income, the expenses, whatever those might be. The system does calculate tax liability. Now, though the system is not a CPA, but it can spitball, give us a really, really good estimate on what our taxes are going to be, whether those are filed on the 1040 or we're using a Schedule C or whatever else that might be. Additionally, we have, and some of you attorneys will be very familiar with these. We can plug in essentially any type of a trust that might exist. So really that's a great question. We can plug in our wills and gifting strategies, plan gifts, things of that nature. Under the facts section, that's where we'll plug in what is, and then when we go over to the plans tab, which is what we were looking at before, this is where we can evaluate what might be. And so we can look at debt reduction strategies as well. I didn't show you on the facts tab, but we can certainly plug in any of our existing liabilities and debts over there as well. So great question. Yes, incredibly robust, and we can do anything with this.
Thank you so much for answering that. As a young professional, sort of thinking about where I want to go, I'm always looking for kind of a little bit of guidance on, what steps would be smarter, sitting on real estate long-term or selling now and looking to get back in later, et cetera, in order to have the healthiest portfolio possible, right? Thank you so much.
Absolutely.
Yeah, and I just wanted to add briefly that we are able to offer everybody on this call and literally about 1,500 people the ability to log on and utilize this digital portal that Dave has kind of showed you the advisor side of, but from the individual side, it is a tool that really does help simplify and consolidate and enable people to really, really take control of their own financial world. So with Miranda's permission, we can follow up with an invitation to log on to everybody who's on this call. And, certainly would love to provide support on how to utilize it, set up budgets, sync accounts, upload any and all important documents in your world, etc. And we will also send a brief 2-minute overview video of really what it is. And it certainly does not commit anybody in any way, shape, or form of becoming a client of Maya Wealth.
That's a generous offering, Mark. Thank you.
You bet.
Yeah, and Mark, thank you for pointing out the budgeting side and the individual side of the software system. I often describe it to people as mint on steroids. So you certainly can run your own budgets, and that's your transactional data, your budgeting data is independently owned by you. It's not anything that we at Maya have any access or visibility to as well.
Awesome. Well, thank you all so much.
Yeah, everybody, thank you for joining.
Thank you.
Sunshine tomorrow, so they say.
All right. See you later, guys.
All right. Thanks.
Have a good day, everyone. Bye. Thanks, everyone.